You'll hear a lot of trading words that may seem odd whether you're in the stock market, day trading forex, or new to cryptocurrency. What do FOMO, ROI, ATH, and HODL mean? Trading and investment have their own vocabulary, and learning all of these new concepts might be difficult. However, if you want to stay up with what's going on in the financial markets, they might be extremely handy. We've gathered a list of some of the most significant trading phrases you should be familiar with if you're trading cryptocurrency in this post. 1. Uncertainty, fear, and doubt, FUD. FUD, although not entirely a trading phrase, is often employed in the context of financial markets. FUD is a strategy that spreads falsehoods about a business, product, or initiative in order to discredit it. The goal is to generate terror in order to obtain an edge. This might be a competitive or tactical advantage, or it could be benefiting from a stock price drop caused by potentially negative news. FUD is fairly popular in the cryptocurrency sector, as one would assume. In many circumstances, after establishing a short position in an asset, investors may disseminate potentially detrimental or deceptive news. Large gains may be generated by short selling or purchasing put options in this manner. They may also position themselves ahead of time through over-the-counter, OTC, transactions. In many situations, the information turns out to be erroneous or, at best, misleading. However, in certain circumstances, it turns out to be true. It's generally a good idea to attempt to think about both sides of an issue. It might be beneficial to consider what benefits someone can get by openly expressing particular beliefs. 2. Disappointment fear, FOMO. FOMO is the worry that investors have when they rush to acquire an asset for fear of losing out on profit potential. Because there are strong emotions at play, FOMO by a huge number of individuals might result in parabolic price fluctuations. Investors FOMOing from asset to asset in a musical chairs game may sometimes indicate the end of a bull market. If you've read our article on technical analysis, TA, blunders, you'll realize that severe market situations may disrupt the market's regular regulations. When emotions are high, many investors may take positions out of fear of missing out. This may result in long movements in both directions, trapping many traders who attempt to counter-trade the crowd. FOMO is also often employed in the development of social networking applications. Have you ever wondered why it's so difficult to see things on social network timelines in perfect chronological order? This is connected to FOMO as well. Users would get the impression that they had viewed all of the newest posts if they could check all of the postings since their previous login. Social media sites try to generate FOMO in consumers by purposely blending older and newer content on the timeline. As a result, consumers return again and again, fearful of missing out on anything crucial. 3. HODL. The phrase, HODL, is a misspelling of the word, hold. It is, in essence, the cryptocurrency version of the buy and hold strategy. The term, HODL, first emerged in a now famous post on the Bitcoin Talk forum in 2013. The word was a typo in the title, IAMHODLING. HODLing is the practice of holding onto investments despite price declines. It's also widely used in the context of investors, HODLers, who, although not adept at short-term trading, wish to get price exposure to cryptocurrency. It may also be employed by investors who have a strong belief in a certain currency and want to hold their investment for a longer length of time. The HODLing strategy is comparable to the conventional market's purchase and hold investment strategy. Buy and hold investors seek inexpensive assets and hold them for an extended period of time. Many Bitcoin investors use this strategy. If you've read our article on dollar cost averaging, DCA, you'll realize that this would have been an extremely lucrative Bitcoin strategy. If you invested $10 in Bitcoin every week for the previous 5 years, you would have more than 7 times your initial investment. 4. BUIDL. BUIDL is a shortened form of HODL. It generally refers to cryptocurrency sector players who continue to grow despite price swings. The basic notion is that strong believers in the crypto business continue to grow the ecosystem despite harsh downturn markets. In this way, BUIDLers sincerely care about what blockchain and cryptocurrencies may offer to the world, and they work hard to achieve this aim. BUIDL is a philosophy that attempts to demonstrate that cryptocurrencies are about more than simply speculation, but also about delivering this technology to the public. It serves as a reminder to put our heads down and continue to construct infrastructure that will benefit billions of people in the future. Furthermore, Baudrillard realized that organizations who continue to create with a long-term attitude will likely perform well in the long run. 5. SAFU. SAFU was inspired by a meme shared by Bizanacci. It quoted Binance CEO Changpeng Zhao, CZ, as claiming that funds remain protected amid unplanned platform downtime. The video quickly went popular in the cryptocurrency community. Binance has responded by establishing the Secure Asset Fund for Users, SAFU, an emergency insurance fund supported by 10% of trading fees. These monies are kept separate in a cold wallet. The concept is that the SAFU may cover the loss of user assets in severe scenarios, providing Binance users with an extra layer of safety. This is why the expression funds or SAFU is often heard. Return on investment, ROI, ROI. Return on investment, ROI, is a method of assessing the performance of an investment. ROI compares the profits on an investment to the initial expenditure. It's also a handy method to compare the performance of various assets. Here's how to compute ROI. You reduce the initial cost of the investment from the current value of the investment. Then you divide that figure by the initial cost. Current value, original cost equals ROI. Assume you purchased Bitcoin for $6,000. Bitcoin is now worth $8,000 on the market. ROI equals 8,000, 6,000, 6,000. ROI equals 0.33. This implies you've made a 33% profit on your initial investment. To obtain a more realistic picture, you need also include the fees, or interest rate, that you must pay. However, raw data do not provide the whole picture. Other considerations come into play while comparing investments. What are the dangers? What is the time frame? What is the asset's liquidity? Can slippage have an impact on your purchasing price? ROI is not the ultimate statistic in and of itself, but it is a valuable tool for measuring the success of your assets. When considering investment returns, calculating position size is critical. Check out how to calculate position size in trading for more information on a simple method that can help you properly manage risk. 7. All-time high, ATH. We don't think we need to explain this one, do we? The all-time high is the asset's highest recorded price. For example, during the 2017 bull market, the ATH of Bitcoin on the Binance BTC USDT pair was 19,798.86 USDT. This signifies that this was the highest Bitcoin price traded on this market pair. One enticing element of an asset achieving an all-time high is the notion that practically everyone who has ever purchased is in profit. If an asset has been in a protracted bear market, many traders holding losing bags will likely wish to quit the market when their position near break-even. However, if the asset exceeds its ATH, there are no sellers ready to depart at break-even. Because there aren't always clear resistance regions ahead, some refer to ATH breaches as blue sky breakouts. ATH breaches are often followed by an increase in trading volume. Why? Day traders may also seize the chance using market orders in order to profit quickly and sell at a higher price. Does breaking the ATH imply that the price will continue to rise indefinitely? Obviously not. At some time, traders and investors will try to take profits and may place limit orders at certain price levels. This is particularly true if prior all-time high levels are repeatedly broken. Parabolic movements often result in extremely steep price losses, as many investors flee when they realize the uptrend may be coming to an end. Consider the price decline that occurred after Bitcoin's parabolic rise above $20,000 in December 2017. Bitcoin plunged over 45% in a few days after hitting an all-time high of $19,798.86. This is why risk management and the usage of a stop-loss are so important. 8. All-time low, ATL. The all-time low, ATL, the inverse of ATH, is the lowest price of an asset. Breaking an asset's all-time low may have the same impact as breaking the all-time high, but in the other direction. Many stop orders may be triggered if the previous all-time low is broken, resulting in a rapid drop. Because there has been no price history below the previous all-time low, the market value might simply continue to fall, drifting lower and lower. Buying at such periods is very dangerous since there are no logical locations for it to end. Many traders will not consider opening a long position until an important moving average or other signal confirms a trend shift. Otherwise, they may wind up holding the bag for an extended period of time, caught in a downward spiral. 9. Do your own research, DYOR. When it comes to financial markets, DYOR is synonymous with fundamental analysis, FA. It suggests that investors should do their own study on their investments rather than relying on others to do it. Don't trust, verify is a similar sounding slogan used in cryptocurrency marketplaces. Successful investors will do their own research and draw their own conclusions. As a result, everybody who wishes to be successful in the financial markets must develop their own distinct trading strategy. This may also result in arguments among investors, which is a fully normal component of investment and trading. One investor may be optimistic on a certain asset, whilst another may be negative. Diverse points of view may accommodate different techniques, and successful traders and investors will use vastly different approaches. The fundamental notion is that they all conducted their own study, arrived at their own findings, and based their investment choices on those conclusions. Due diligence, DD. Due diligence, DD, is connected to DYOR in several ways. It refers to the inquiry and care that a reasonable individual or corporation should use before reaching an agreement with another party. When reasonable commercial entities reach an agreement, it is assumed that they would do due diligence on one another. Why? Any sensible party wants to make certain that there are no possible red flags in the transaction. Otherwise, how could they weigh the prospective dangers against the anticipated benefits? The same may be said for investments. When looking for new investments, investors must do their own due diligence on the project to ensure that they can account for all risks. Otherwise, they would be unable to regulate their investment judgments and may end up making poor selections. 11. Anti-money laundering, AML. Anti-money laundering, AML, refers to a set of rules, laws, and processes designed to prevent criminals from passing off unlawfully acquired funds as legitimate earnings. AML regulations make it considerably more difficult for criminals to launder their money by concealing or misrepresenting it as originating from lawful sources. Criminals will constantly try to hide the genuine source of their income. Because of the complexities of the financial markets, there may be several approaches. Derivatives goods made up of derivatives products, as well as other complicated market manipulations, may make it difficult to trace the real source of cash, though not impossible. AML standards compel financial organizations, such as banks, to monitor their clients' activities and report on any suspicious conduct. Criminals are less likely to get away with laundering unlawfully acquired cash this way. 12. Know your customer, KYC. National and international regulations must be followed by stock exchanges and trading platforms. The New York Stock Exchange, NYSE, and the Nasdaq, for example, must adhere to U.S. government laws. Know your customer, KYC, or know your client rules guarantee that institutions that facilitate financial instrument trading check their clients' identities. What is the significance of this? The major purpose for this is to reduce the possibility of money laundering. Furthermore, KYC laws do not apply just to financial sector players. Many additional portions must also follow these rules. KYC requirements are often part of a larger anti-money laundering, AML, strategy. Final thoughts. At first glance, cryptocurrency trading phrases might be perplexing. But now that you've learned a fair portion of them, you may feel more safu with all these acronyms. Make careful to DYOR on FUD rather than FOMO into a coin that has already achieved ATH, and keep HOD Ling and BUID Ling. Thank you for watching.